Most new traders don't fail because of bad strategy. They fail because of how their brain handles money, risk, and loss. When I first started trading, I was focused entirely on chasing the number, results over process. All I could think about was how much I was up or down. I realized later that was exactly the wrong approach. The numbers are brutal. Research consistently shows that roughly 70% of day traders lose money in any given year. Over a 5-year period, that figure climbs toward 90%. But here is what most people miss. It is not the percentage that matters. It is the reason behind it. The popular assumption is that traders lose because they pick bad stocks, or because they don't understand technical analysis, or because the market is somehow stacked against small accounts. None of those are the real reason. The core issue is psychology. Specifically, 3 mental traps that are hardwired into the human brain. These same instincts kept our ancestors alive through famine, drought, and predators. But inside a brokerage account, those same instincts become financial poison. What makes these traps so destructive is that they feel like logic. They feel like careful, reasonable decisions in the moment. That is exactly what makes them dangerous. When I started out, I put almost all my attention on results and very little on the process. For a trader, that is fatal. I was neglecting the psychological side entirely. That meant I had no idea why my account kept shrinking. Stay with me. By the end of this video, you will be able to identify each trap before it costs you real money. The scientific study of why people make irrational financial decisions has a name: behavioral finance. The field was built largely by 2 psychologists, Daniel Kahneman and Amos Tversky. Their work in the 1970s fundamentally changed how economists think about human behavior. Their core finding was simple: people are not rational actors. We never were. We are emotional creatures shaped by evolution to survive, not to invest. 3 specific traps emerge from decades of this research. Each one has been documented across thousands of trading accounts. Each one has a name, and each one has a practical solution. In 1979, Kahneman and Tversky published a landmark paper called Prospect Theory. It contained one of the most important insights in financial psychology. Losses feel roughly twice as painful as equivalent gains feel good. That asymmetry is not a character flaw. It is a built-in feature of the human nervous system. It stopped our ancestors from gambling their survival on uncertain outcomes. But in trading, this wiring creates a specific and expensive problem. New traders hold losing positions far too long. Cutting a loss feels like permanent defeat. The brain resists it. At the same time, those same traders exit winning positions too early. The moment a trade moves up, the brain sends a clear signal. Take the profit now, protect it, what if it reverses? The result is a portfolio of small wins and large losses. That equation only moves in one direction. Research from the Delbar Institute found that the average individual investor underperforms the market by nearly 4 percentage points per year. Not because of high fees, not because of bad entry timing, because of emotional decision-making rooted in loss aversion. Holding losses while cutting gains early, this is prospect theory in real life. I traded exactly like this. Once you fall into that loop, it is very hard to escape. Breaking free from that pattern took me much longer than I expected. A study published in the Journal of Finance followed tens of thousands of individual brokerage accounts across a 5-year period. The finding was counterintuitive. The most active traders produced the lowest returns. Not because they lacked intelligence, because they had too much confidence. Overconfidence is the belief that your skill and judgment are above average. By mathematical definition, most people cannot be above average, but most people believe they are. In trading, overconfidence follows a specific pattern. A new trader has a handful of early wins. The brain records those wins as proof of personal skill. It edits out the role of luck, favorable conditions, or fortunate timing. The trader then increases position sizes. They take on more risk. They quietly abandon their original plan. This cognitive error is sometimes called the hot hand fallacy. Researchers first identified it in basketball studies from 1985. Players and fans believed in winning streaks, even when the data showed no such pattern existed. The same error plays out in trading accounts every single day. 3 good trades in a row. The account is up. The trader feels invincible. Position size doubles on the next trade. That trade fails. And the loss erases all 3 previous wins. Anchoring is the tendency to rely too heavily on the first piece of information you receive. In trading, it works like this. You buy a stock at $40 per share. The price drops to $30. Your brain anchors to $40. That number becomes the real value in your mind. Every decision you make from that point is filtered through the lens of the original price. You tell yourself, I will sell when it gets back to 40. You hold. The stock drops to 20, then to 15. Anchoring has turned a manageable loss into a serious one. Research from the National Bureau of Economic Research found that investors are significantly more likely to sell a stock after it recovers to the original purchase price, even when the company's fundamentals have changed, even when better opportunities exist elsewhere. The original price becomes a psychological prison, and most traders don't realize they are already inside it. Case study 1. Loss aversion in action. Consider a trader we will call Alex. Alex opened an account with $5,000. The first few months were encouraging. Individual trades began representing a larger share of the total account. The original risk management plan was quietly set aside. When market conditions shifted, the losses arrived quickly. Morgan had no clear framework for the new environment. The gains reversed. Within 4 months, the account had fallen below its starting balance. In my own experience, early success worked against me. Even poor trading decisions can produce profits sometimes, and when they do, you end up with a reason to keep making those same poor decisions. Case study 3. The anchor that would not break. This third pattern may be the most common of all. A trader enters a position based on solid analysis. The position moves against them. Instead of reassessing, the trader anchors to the original thesis. They search for new information that confirms their initial view. This is confirmation bias layered directly on top of anchoring. The position continues to decline. The trader continues to hold. Sometimes they add to the position at lower prices, believing they are getting a discount. The account shrinks over weeks or months. The original thesis never plays out. This pattern appears across every asset class. The asset type does not matter. The psychological structure is identical. Small gains accumulated. Confidence grew. Then one position turned against the trade. Alex's original plan required an exit at a 5% loss. When that level was reached, the brain said, "It will recover. Just wait." It did not recover. Alex held through a 20% decline, then a 30% decline. By the time Alex finally closed the position, the account had lost nearly 60% of what was in that trade. The planned loss would have been manageable. The actual loss exceeded $3,000. Alex then tried to recover through more aggressive trading. That pattern has a name. We covered it in a previous video. Revenge trading. The second trap compounded the first. The account was effectively gone within 6 months. Case study 2. Overconfidence in a rising market. A separate pattern involves traders who see genuine early success. A trader we will call Morgan generated solid returns during the first quarter of a strong bull market. Morgan had been trading for less than a year. During that period, the broader market was rising across most sectors. Nearly any position in almost any asset would have produced gains. But Morgan's brain attributed all the returns to personal skill. Position sizes grew. Here is the honest answer most trading courses skip. You cannot eliminate these biases. They are part of the human operating system. Fix 3. Remove the purchase price from view. This is the most unconventional fix, but it has research behind it. If you can hide the original purchase price from your trading screen, do it. Then change the question you ask yourself. Instead of asking, am I up or down from where I bought, ask, what would I do with this position if I were seeing it for the first time today? That question removes the anchor. It forces a forward-looking assessment rather than a backward-looking one. Several professional traders use this method specifically to break the anchoring cycle. My own trading rules are simple. 1. Always set a stop loss and limit your risk. 2. Never trade against the broader trend or the fundamentals. 3. Wait for your setup on the trading time frame. There are smaller rules underneath, but these 3 are the foundation. Evolution embedded them. They are not going away through willpower alone, but you can build a system that removes the emotional brain from critical decisions. Fix 1. Written exit rules. Before entering any trade, write down the exact price level at which you will exit the losing position. Not in your head, on paper, or in a document. Then treat that exit level as non-negotiable. When the price reaches that level, you exit. No reassessment. No waiting. No exceptions. Most traders know what a stop loss is. Far fewer actually follow one. Loss aversion makes it feel wrong in the moment. More discipline is not the answer. Removing the decision entirely is. Fix 2. Track outcomes by dollar value, not win. Count overconfidence grows when you count wins. 3 wins and 2 losses sounds like 60% accuracy. That feels positive. But if the 3 wins are small and the 2 losses are large, you are losing money with a winning record. Track every outcome by dollar value. A trade that returns $50 is not the same as a trade that returns $500. Regard both numbers consistently. This forces an honest picture of performance that the emotional brain cannot distort. The market is not the problem, your brain is. Loss aversion, overconfidence, and anchoring are not signs of weakness. They are signs of being human. Every trader carries these biases. The ones who survive long-term are simply better at building systems that work around them. Write the rules before you need them. Track what actually matters. Remove the anchors. This is not financial advice, but it is the psychology behind most of the accounts that do not make it. Subscribe if you want more of the math and psychology behind money. Drop a comment below with the trap you recognize most in yourself. That honest self-assessment is worth more than any strategy.